Hi there, this is Christian Dye from Latitude West Financial. We are giving an financial accounting workshop for our valued dental clients. It is my pleasure to have our guest, Nathan Morrison from Provision Chartered Professional Accountants. And we'll be talking about understanding corporate accounting, dental practice valuations for those of you thinking of buying a dental practice, some mistakes to avoid, and some strategies for minimizing taxation inside your corporation. So I think let's just jump right into it. For those of you who are in dental school, I remind you that you should join my Instagram at Latitude West Financial. Each week we give away a Visa gift card. And this is geared towards people in dentistry or in residency. And it doesn't have to be UBC dentistry. If you're in dental school anywhere in Canada, then by all means, please join. Quick disclaimer, the information given today is not to be considered as tax advice. We advise that you do your own research and work with your professionals. What we're doing is for educational purposes only. So we want to start by talking about buying a practice for those of you who are in dental school or graduated dental school and you want to know a little bit more about it. So our first question is, if considering buying a dental practice, what is a first step? Nathan, from your opinion, having worked with many dental clients, and they talk to you about, transitioning from an associate to a dentist, what would you say your advice to them would be for a first step?
I would say, Christian, one of the things that's it's always a bigger jump than people realize. Moving from being an associate to being a practice owner, owning a practice is just like owning a business, and it's there's a lot of complication that comes with it. So one piece of advice I often give young associates who are looking at taking that jump would be just to check in with some of their colleagues who have made that jump and chat with them and say, hey, listen, what are some of the things that you wish you knew before you started, and what are the things, some of the things that you wish you could do over. Because when you jump into a practice, there's a lot of complication dealing with people, dealing with supplies and customers and payroll. So that's kind of one of the non-financial pieces of advice I like to give out.
No, that sounds great. I would take it one step further, figuring out what questions to ask them. I would kind of say, what is it that you love more about being an owner? And then what I'd say, something like, well, what are your biggest challenges that you didn't have as an associate? And then kind of just pause and wait to hear what comes out of their mouth. Some other things that I, would like to say with my MBA background is I would ask, what is your reason why? A quick little SWOT analysis, and that is strengths, weaknesses, opportunities, and threats. Maybe even have someone else, maybe a colleague, an advisor, your accountant, maybe look this over if you're really honest with yourself, to take a look at the list. And then maybe, you might be avoiding a problem by looking at this. Some example of strengths might be, really interested in owning a business. You might enjoy dealing with people. You like solving human relation problems. You might want to make more money. Maybe you've got a bit of a business background and you're maybe eager to learn something else different than just being a dental practitioner. That to me would be considered strengths. Some weaknesses might be, maybe you lack any sort of business knowledge. Maybe you dislike dealing with people. Maybe you're bad with numbers. Maybe you're really nervous to start a business. If you have to take on considerable debt, maybe, that these are all considered weaknesses. Some opportunities might be, you could be inheriting a practice. Maybe you speak the language. That might be an advantage. Maybe there are many dentists in your family. Maybe you're willing to relocate. Maybe you're eager to learn. And then, of course, there's the threats. I'm just going to get that. Hold on. So then we have our opportunities. Maybe with our threats, maybe your time is limited. You might be getting married, having kids. You maybe have a history of not following through. High current debts might be causing you stress and taking on more. And maybe you're just not very good under pressure. So Maybe you'll also be a fairly anxious person. So these are things that I would sort of say be a little bit careful of. These are the things that might add way more stress to your life than you actually need at that given time. You might be able to, of course, do something. Maybe the timing is just not right. So another question. What should a dentist understand regarding corporate accounting? So this is kind of in your wheelhouse. So some basics of corporate accounting. Help us out with, there's a list of things that they just might not be familiar with. Nathan, tell me, what are some important ones that they might not fully understand? Maybe something off of the list that you'd like to explain.
Sure. Thanks, Christian. So accounting is almost like a whole new language unto itself. We've created words or we've appropriated words from other areas. And, as a regular, as a dentist out there, you might look at some of these words and think, you know what they are, but as an accountant, they can mean something totally different. And, I think it's important for, business owner, a practice owner to have an understanding of some of these accounting definitions. So, I'll just run quickly down the list. I'm not going to go through them all, but everybody I think knows assets and liabilities. Assets are things you own. Your receivables, your cash, your property. Liabilities are things you owe. Your banking loan, your accounts payable. Income and expenses are pretty straightforward. Working capital is one that's thrown around a lot when you're looking at buying a practice. And effectively, working capital is the cash and cash-like assets and liabilities that are used to run the business. So at a basic level, you need to make sure you have, say, $30,000 or $40,000 or $50,000 in the bank, on a regular basis to be able to pay your expenses. So it's basically the working capital of the business. Goodwill is essentially the intangible assets of the business, things you can't touch and feel, unlike, say, property and buildings and equipment that you can actually pick up. Goodwill is things like your patient list and the intangibles of the business. Retained earnings is kind of the profit left in the business on a year-by-year basis. Accounts receivable is pretty straightforward. Amortization is how we expense capital purchases, like your leaseholds, like a building, like a large piece of equipment. And so we amortize it over a number of years based on the useful life of that piece of equipment. Fair market value versus book value. Everybody kind of understands it. I think fair market value is what's it actually worth today, and book value is, essentially the cost, initial purchase price. Where that does come into play is most of our financial statements don't take fair market value into account. We simply, as accountants, focus for the financial statements on the book value. And so oftentimes, for investments per se, or building, it'll be on the financial statements at, $500,000 the purchase price, but really it's worth, $1.5 million, and people get confused about that. Net present value, that's a little bit more complicated. Basically, the idea behind net present value is if we're looking at some cash that you're going to receive either on an annual basis or at a certain point in the future, what's the value of that today? What would you have to receive today to forego that future cash flow? And discount rate actually kind of comes into play with net present value. It's basically the discount rate or the general interest rate we would use to create and come up with a net present value. So those are some basic explanations for these terms that you've got up here, Christian.
Yeah, and I think it can be very confusing when someone is reading a financial statement, because somebody says, "Hey, I want to buy a business," and they'll sit down with their accountant, they'll kind of go over the financials, and it'll just look very confusing. So with the balance sheet, you'll have the current assets and the current liabilities. Then you start to see these terms come at you, like retained earnings, you have share capital, and we're not going to try to, in this session, try to give an accounting lesson. But what I want to do is I kind of want to go over just the basics of some things that people should be looking out for, and some things that they should try to understand. And when we look at all of these terms, if you don't even know what the terms mean, then it's going to be very, very difficult to understand its meanings of how it's going to affect the business.
True.
So I think when it comes to the financial statements, one of the things that I've always said to look out for is to try to understand what is the cash flow and what are the expenses. And I find it tends to be a little bit more meaningful if we were to take one of these financial statements and compare it to another financial statement of another practice, because that in and of by itself, it's hard to understand what it is. So the quick thing I would do is, if you were thinking of buying a practice, make sure you're familiar with all of the accounting terms inside the balance sheets.
Yeah.
All right, let's move on here. Now, how is a dental practice valued from an accountant? So this, somebody says, I want to buy your practice. How much does it cost? They says, well, it's worth 1.5 million. I kind of want to try to understand where that number comes from. So the valuation of a dental practice, how is value determined? So walk us through it.
Sure. So when any business, specifically a dental practice, is valued, there are a few things in there that are valued. And what you're looking at is, I'm going to leave goodwill to last. So you're looking at the fair FMV, which is accounting terminology for the fair market value of the capital assets. And so what that is all of the capital assets of the practice. So leasehold equipment, if there's building in there, all the large equipment, and certain supplies. So all those capital assets, what's the fair market value of those? As in, what are they worth today? Then you've got working capital, which is another term we used, we looked at earlier, which is effectively the short-term assets and liabilities, receivables, payables, and the cash in the business. Other assets, oftentimes there are other assets in it that are going to be retained by the vendor and carved out of the purchase price. And so, when we look at a practice, those are the hard assets in the business. And then we get to goodwill. And goodwill, like I said before, is that intangible. You can't touch it, you can't see it, you can't feel it, but it's there as value. And especially when we look at dental practices, Christian, the goodwill portion of the valuation is usually fairly high. And the goodwill in a dental practice really comes down to a big part of it is the patient list, right? The charts. And how many charts are there? How active are they? What type of services are being provided? And then, other things that make up goodwill are, the quality of the staff, the quality of the location, all those kind of things that, when you go to look at a dental practice, you say, oh, this is a good dental practice. And you can't really put your finger on why, but it's all those intangible things. So that's what makes up goodwill. And those are kind of the components of a valued dental practice.
Got it. So, I guess tell us a little bit about its valuation from projections of future cash flows.
Sure. So there are a few different ways that dental practice valuers and general business valuators can value a business. And one of them is future cash flows. And effectively, on a simple level, what future cash flows is taking a look at the history of a business, the history of a practice, and projecting out the next 3 to 5 years typically of that practice, and saying, based on what the practice has done historically for the previous 3 years, our projection for the next 3 to 5 years is going to be X, and it's going to create net income or positive cash flow of $300,000 a year for the next 5 years. And then when we determine that projected amount of future cash flows, then the next step is to look at, what's the present value, what's the net present value of those future cash flows.
Got it. And then, so, there's a nice mathematical formula that says, if I'm going to, generate $300,000 per year for the next 10 years, there's an amount that I'm going to get right now.
Although I wouldn't call it a nice formula. It's quite complex and ugly, as a matter of fact.
I'm a math guy, so of course I love those formulas. But I guess my one question is, how on earth, well, I'm not sure if you could even answer this, how, for some of the goodwill, such as a good staff or a good team or whatever, 600 patients, how hard is it to put a dollar figure to some of those things?
Well, in reality, when you look at, especially a dental practice, part of what comes into play is, what does the market say?
Yeah. Yeah.
And especially in the lower mainland where you and I both are right now, they're a real strong portion of how those valuators get to a price is what's the market willing to bear? What are people willing to pay?
Hmm.
And if they've got a practice and it looks like the market says, based on other similar practices purchased and sold, the market's willing to pay 1.5 million. In reality, the valuation is going to find its way to 1.5 million.
Yeah.
And much like real estate,
Yeah.
the valuation of a dental practice is tied closely to what's the market saying.
Yeah, but I guess that's really important to make sure that even if the market is saying that, much like real estate, if you're doing it as an investment, does the investment make sense? Investing in a piece of real estate in certain areas in Vancouver doesn't make sense if you're doing it for cash flow. So a dental practice would much be the same. So
Christian, I'm just gonna close my blind here so I don't have the sun in my face.
Yeah, no problem.
There we go. Not so shiny.
Yeah, so I know that there is a couple methods to value a practice properly. One is the valuation method by revenue. Want to talk to us a little bit about this?
Right. So again, similar to the future cash flows, what we're doing is we're looking at the history and we're looking at the revenue. And typically there's typically 3 years of history that are taken into account. And the evaluator is looking at that, that 3 years of revenue and looking at how we got to that revenue. And they do like to normalize it by, if you have 1 year that's really high or 1 year that's really low, they'll kind of average it out. And so they'll take kind of 3 years of history and get an average of those 3 years. Let's say that, that average is $1 million. And then they will effectively apply a multiplier. And, we've got a multiplier down there at 130%. So if you've got, a practice that's at $1 million, so it's like, year one was 900,000 in revenue, year two was 1.1, and year three was $1 million. So we average out to $1 million. They're going to apply a multiplier of our number there, 130%. They're going to get to $1.3 million price. And again, where the question then becomes, okay, well, where does that 130% come from? And like you and I just talked about, that number, a lot of that comes from what's the market willing to pay. And, it depends on the location. So I would say that's a good average percentage. I would say, in the lower mainland, Vancouver, Burnaby, Richmond area, we're starting to see higher than that, up to 140% multiplier. I would say further away from, the main city centers, we see a lower number, closer to 100% per se. And so it really depends on, a lot of it does depend on the higher level location. But effectively, they'll take the average of, say, 3 years and apply a multiplier to it, and that's how they get to that number.
This is just like gross revenues coming in. This
correct.
Is yeah, okay.
Ignoring expenses at this point.
Got it. Okay. And then the future cash flows method, which is the one that we've talked about a little bit. To walk us through this one a bit.
So again, it's not overly different. What we're doing is we are still starting the history, looking at the previous 3 years, but instead of just taking an average of those 3 years and applying a multiplier to it, effectively what we're going to do here is we're going to take that average, we're going to look at it, and then we're going to project out over the next 5 years what we think the revenue and expenses are going to be. And so there's some room for manipulation in there. And I don't, manipulation sounds like a negative word, but I don't mean it in a negative sense. I mean, what you can do is you can say, look at the history and say, okay, here's what the revenue was, but I know as evaluator that the practice actually has room to grow beyond where it's been. And so, if the right person comes in there and grows it, we're going to actually see higher revenues that are going to increase on a year-by-year basis. And then you can have the same thing with expenses, and there's some flexibility in what they do with those expenses. And so again, effectively though, at the end of the day, what we're doing is we're projecting out 5 years, and we're going to end up with an annual cash flow, annual positive cash flow at the end of every year. And then we're going to take that up and add it all up, use a discount rate, and create, a net present value. What are those 5 years of positive cash flows worth today?
Got it. No. So to my understanding, this one over here might not be as common as the other method, or, just what the fair market value might bear.
Not as common in the dental market. No, we're certainly, we are seeing the revenue multiplier on a regular basis, much more regularly than discounted cash flows.
Got it. So then we have sort of financial versus non-financial considerations, such as the list below. And when we take a look at financial consideration, just siphoning them out a little bit, I think you're a dentist will see all of these different things, and I guess it's good for them to be able to categorize which ones are financial and which ones are non-financial considerations.
Yep.
Financial considerations, of course, be revenues, wages, salaries, annual expenses, contracts, purchase loan payments, and some key non-financial considerations. Do you want to talk to us about this one a little bit?
Sure. So you always want to focus not just on the financial, but like you said, the non-financial considerations. And so, we look at things like location, number of chairs, staff, hours of operation, the lease, age of the equipment. So these are all really important. And, a lot of these really lend themselves to an understanding of what can I do with this practice? Can I grow this practice? Can I do something more than what has been done by the current owner? And so the location obviously is really important. Is there is it a ground level office? Is there a lot of traffic? Is it in an area where there's a lot of competition, right? So the location can be positive or negative. It can be one of, there's lots of people nearby, lots of people see your practice, but it can also be one where, you step out the front door and there's 2 or 3 dentist offices nearby. So that's an important question. Number of chairs, size of the space. Is there room to grow, right? Are there unused chairs? Is there unused chair time that we can develop this practice further?
Yeah, I sort of find that the key non-financial considerations is actually where they could add value. If you kind of want to get something, potentially not that it's undervalued, but it's that you can add value to it. I know one dentist that is a client said that a nice formula he likes to do is he'll find kind of a practice that's not in the greatest of locations, and maybe is being leased. He'll find an area, a location that he could buy that's in a good location. He'll then buy that kind of, struggling practice, but then he'll move it to the space that he just bought.
Right.
Now he's got the patient list and he's got, the space that he bought. So it's kind of like a real estate investment that's creating a business opportunity with cash flow. And of course, because he's also a dentist. The beautiful thing about, starting a business as a dentist when you're buying the actual space is that the banks will lend you up to, 110%, in some cases.
Yep.
And like, if you want to buy a piece of real estate in Vancouver as investment property, that's 20% down payment. You want to buy commercial real estate, that's 30 to 35%. You're a dentist and you want to buy a piece of real estate and start a dental practice, that's 0%. That's actually negative 10%. That's insane.
It's a great opportunity.
Great opportunity. Okay, so let's go on our next question. How can you determine if a dental practice is overvalued? Now, I know a lot of people would love to kind of, hear or talk about this a little bit. So here's my multiple choice question. Where can a practice accounting statement often overstate its valuation and why? So this is for the listeners out there. Okay, so the answer is, of course, it's usually in the expenses. So if you're trying to read accounting statements and you're trying to understand the practice that you're about to buy and you're wondering where are some places where it might be overinflated, start with the expenses and start looking at it there. Because if expenses are lower than usual, then the net operating income will appear to be higher than usual. So now overinflating valuation. So if we take a look at our our case study, there are four common areas and expenses where an item can be omitted or undervalued. So we take a look at our case study, and when we're looking at this, flashing forward here, one place where we might start is wages. So in our expenses, we see wages and benefits. Now, one of the areas in wages that we should typically talk about, typically 35 to 40% of dental revenues, but the vendor may not charge on their own production. Nathan, tell me about this. What is going on here?
So this is common practice as a dental owner, is to compensate yourself some of the time with a wage, some of the time with a dividend. And if you're not taking a wage, perhaps taking a dividend, your wage is not showing up in this income statement. It's not showing up in the wages and benefits expenses. And one of the things to be aware of when you're looking at a dental practice income statement is that exact issue. And when you look at those wages and you're looking at the bottom line, the net income, you need to know, is the dentist receiving a wage or not? Because you may look at a practice and think, oh, operating income of 65,000, that's great, net income after taxes. But if the fair market value of the dentist wage, maybe there's two owners in there that aren't being paid, and they each should be being paid $175,000 salary, and that's going to knock your the actual value of the net income down by 350,000 down to 250. All of a sudden, the practice isn't pumping out as much cash as you think it is. So it's just important to get an understanding for that, so that you're able to really see what are the actual end of the day cash flows for this practice.
Excellent. So one place where it could seem overvalued, ask about, is the owner's wages included in the expenses?
Yes.
Second one over here is rents. Is the current rent undervalued? How does this occur? So tell me a little bit about rents.
So what can happen is, you can have a situation where, like you talked about earlier, dental practice owner also owning the building. If the dental practice owner owns the building and perhaps owns it in a different corporation or in a different entity, then you're going to have a rental agreement between these two related parties. And it may be in that dentist's best interest while he or she is operating her practice to keep that rent low. And so an important thing to look at is compare the rent expense to the fair market value rent paid by similar practices nearby or similar tenants nearby, and to ensure that there's a fair market value rent expense. And if there isn't, if for some reason the rent is lower due to a related party transaction, that's something we're going to want to mentally adjust when we look at the value, when we look at the income of a practice.
Yeah, and I guess one question that I would be asking as well is, what was the terms of the last lease? Because maybe you just happen to be in a lease agreement where you've been grandfathered these low rates for 5-6 years, but they're up for renewal in 2 years. And suddenly, especially here in Vancouver, rental rates have, jumped up dramatically, and you might end up getting hit with a new rental rate agreement double, for example. And that's not uncommon, where suddenly the rents are double. So, figuring out what the lease agreement is, maybe asking the question, is it possible before I buy this practice for me to speak with the landlord?
And the other thing you want to do
intention is
make sure you get, you want to have a look at that lease agreement, because it may be written in that lease agreement that if the tenant attempts to assign the lease to a purchaser, the landlord can actually go ahead and increase the rent right there.
Yeah. Excellent. And
so it's really important to look through those and probably, go ahead.
Okay, so this third one, regular expenses add backs. So what exactly is an add back?
So this is an area that isn't actually typically on the financial statement, but it's in the dental practice valuation. And what happens with these valuators when they're normalizing the revenue and normalizing the expenses? One of the things they do is they go through the expenses and they comb through those expenses to see, okay, what kind of things can we add back and remove as expenses because they're not a regular dental practice expense. So they're higher than the ordinary average dental practice. And so it's an important thing to look at, because they'll go through and they'll look at things like professional development and travels and insurance and meals and entertainment. And they'll basically take the financial statements of the practice and decrease the expenses to normal amounts. And sometimes those normal amounts can be pretty skimpy. And so that's something to look for as well, to make sure that they're not, say, taking advertising, say, down from 24,000, which is probably a reasonable amount, down to, $6,000 a year, and then artificially increasing the net income. So that's one thing to be aware of, and specifically when you're looking at the dental practice valuations.
Yeah. So, I guess this would be a harder one to try to uncover or catch. So maybe some question to ask is when somebody says travel expenses or professional development, you might ask, well, what was this made up of? And then see if it's reasonable. But I like your one on marketing. I never really thought about that one, because marketing could be literally nothing, or it could be as much as $50,000. And trying to uncover, and especially a young practice needs to invest in marketing as well,
or a growing practice. Arguably, a purchaser is going to want to do, right?
Yeah, so maybe one way is looking to see what is the consistency over the last 5 years as opposed to just the last year.
Yep.
So next one, equipment. Tell me a little bit about this, how this can be an area where someone might overinflate net operating income.
So equipment again comes in, and what it's going to impact is really the value of the practice. And the idea here is, there's a lot of leeway in valuing equipment, and whether you're looking at the historical cost or the current fair market value or the replacement cost, oftentimes the value of equipment can be placed in such a way that yes, that it's a correct valuation, but if a new dentist comes in and isn't happy with the equipment, and they want to replace it, they're not typically able to get that value out of that equipment, i.e. selling it to a third party and then using the proceeds to put towards their new equipment. And so as much as there's a value placed on it, if it's not the right equipment, then it's almost an artificial value that isn't the purchaser is not going to be able to take advantage of.
Yeah, makes sense. Maybe some questions to ask. How old is the current equipment? Maybe try to itemize a list. Calculate your own replacement cost for the older equipment. This will give you, because remember, you're buying the place and you're looking forward. So this was really good. These were some great 4 areas to concentrate on where we can try to see maybe there is some overinflation, and then maybe, maybe there is some wiggle room to try to bring that purchase price down. So, this last question, what strategies exist to minimize taxation while increasing investments inside of a corporation? So most people will incorporate, but, they may have their dental practice now. And of course, hopefully they have some form of retained earnings, and they need to now, figure out what they can do to kind of minimize taxation and increase wealth. What would you say, Nathan?
I would say, Christian, the primary tax minimization value of a corporation to a dental practice owner is the ability to gain access to the small business tax rate, which is 12%, and avoid as much as possible the top personal tax rate, which is just over 53%. And so as a dental professional, if you're unincorporated, you're operating as a sole proprietor, all of your income up over 200 grand is taxed at just over 53%. Whereas as an incorporated dental professional, whether you're a practice owner or an associate, the first $500,000 of income is taxed at a flat rate of 12%, which creates a massive tax saving and tax deferral for the incorporated professional. Now, everybody says, obviously you're going to take some funds out of the corporation via dividends or wages as your personal compensation, because everybody's got to live. You got to put a roof over your head. You got to take vacations. You got to eat. So you're going to pay some personal tax when you take that money out. But the key, Christian, and you know this, is what can you leave in that company? And so, we talked earlier about, annual cash flows. Well, let's say you've got somebody with annual cash flows, net income after expenses of $300,000. So they got revenues of $1 million, expenses of $700,000, they're left with $300,000. And let's say that person only needs $120,000, 10 grand a month for their personal living costs. And so that leaves them with, what's that, 180,000. Now ignore, there'll be some corporate taxes off of there, and there'll be some personal taxes off the 120. But if they can leave a good chunk of, say, that remaining 180,000, maybe they leave, say, 150 in there, or even 100,000 as corporate retained earnings, so it doesn't come out, they leave it in the corp. There's a massive, massive tax saving, and they're left with far more to invest in the corporation than they would have to invest in their hands personally if they were unincorporated. So from my perspective, that is one of the primary benefits of incorporating for tax purposes.
Yeah, and then usually when you're kind of convincing them to incorporate and to leave as much money in there as possible, then kind of the baton is handed to me,
right,
now to do something with what's inside of it. So it's kind of a bit of a catch-22 because you're saving on taxes by leaving it in, but stocks, bonds, especially GICs, they're taxed higher inside of a corporation when we're actually building it. So that's where the advisor comes in and say, what can we do in order to still create wealth, but trying to minimize that taxation? There's multiple strategies, to be honest, but I'm just going to kind of pick on one. And this is kind of the biggest one. And a really, really big one is probably to do something like an IFA. It stands for Immediate Financing Arrangement. And what a lot of people here do is they'll use the corporation to fuel money into an asset, like an estate bond, and then they'll borrow against it coming back out. And then they'll reinvest it in another vehicle, such as real estate, or another vehicle, such as, the stock market. So now they have two assets that are growing at the same time. The tricky part of an IFA is that you got to qualify for it. There'd probably be two different people involved, and the main one is the banks. The banks would have to qualify you for this. One of the things the banks would be looking for is to see if you have enough retained earnings and cash flow for the IFA to make sense. So some loose numbers that I like to say is about 100,000 per year of retained earnings. And then the bank would overlook this to make sure that that's correct. And if it was the case, and if you did decide to do the IFA, essentially the way it works is it's like investing and then borrowing against it to reinvest. That's kind of the flow of an IFA. But some of the goodies that you get out of this is you now have two assets that are growing. And at the very, very end, it's backed against an insurance policy. And insurance policies pay out tax-free inside the corporation, and they build up a CDA credit, stands for a capital dividend account. The capital dividend account could then be used to bring money out of the corporation tax-free to the shareholders, which is typically, beneficiaries, but it also leaves enough room to bring other assets out with it, depending on how many credits you might have. So what are some reasons that you might want to consider to do an IFA is, one, if you're comfortable with leveraging against investments in a corporation, if you want to create these CDA credits, and if you want a very, very tax efficient estate transfer of assets that you're building in the corporation to go to your beneficiaries. And along the way, you are able to reduce taxes because it is creating some tax deductions for you. Just to show you a really, really quick sample of an IFA. Here we have a client who's depositing a little under 300,000 per year for only for 10 years. The cash values of the IFA build to about 3.5 million, but because they borrow against it, they essentially have another asset on the side. And in this case, this was a real estate asset. So there's 300,000 times by 10 years, that's $3 million that was going to build this real estate asset. Once the real estate asset was built, they still had, this other asset of the IFA that was worth about 3.5 million. But now that's in year end of year 10. By end of year 25, they haven't contributed to it since year 10. The cash surrender value is about 5.4 million. And the loan balance of the money that you borrowed is only at 4.5 million. So there's already about 900,000 of the asset that's available if you were to cash in the IFA. But now let's take this even further to retirement at age 70. Now the numbers are even greater. You have a 6.4 million asset and you have an outstanding loan balance of only 4.8. Now remember, you still have that $3 million piece of real estate that you invested into on the side. Now, if we took the IFA, never canceled it, but took it all the way to life expectancy, you would now have a net corporate death benefit of about 8.6 million, but you'd have a CDA credit of 15 million. And so what happens to that extra 7 million of CDA credit? Your other assets inside the corporation can be used in order to bring them out, such as the real estate investment that you created. So that's a really, really fast version of an IFA. Is it for everybody? No, there has to be, certain criteria. I would have to go through this to see if you would be, appropriate depending on your risk profile. But what we do is whenever we run an IFA for a client, we always show them what life would look like if they just invested without it. Then we show them what life would look like if we invested with it. And for a lot of people, it does make sense. It does make sense. So here our graphic shows the cash value over time. If they were to not do the IFA, that's the bottom line, the orange one. And if they were to do the IFA, and this is on the cash values, and on the estate values, again, the orange one is if they were to do it without, and the gray line is if they were to do it with. This was based off the last sample. So the result of the example that I just gave, is that you have this, net cash value that the IFA has created about 1.6 million at age 70, or you've got this net estate benefit of 15.1 million CDA credit, as well as an 8.6 million proceeds upon, life expectancy. So if an IFA kind of sounds like, something that you'd like to hear more about to see if it fits your scenario, by all means, feel free to reach out and connect, and we could do that illustration for you. So typical IFA clients are high income earners who are business owners or individuals who have steady cash flow, who have retained earnings inside their corporation. And essentially they're at a very, very high income tax rate. They're looking for ways to reduce their income tax rate inside their corporation. So now we come to our conclusion. If there's any questions that anybody has based off of anything that both Nathan or I have said, feel free to email and contact us. Feel free to set up a complimentary phone call. I know that with our process, we love to talk with our existing clients who might have a question about something we have done, or we like to talk with new clients if somebody's listening and they're not a client of neither Nathan or myself, but they just want to start a conversation. So how can we help? So if we can help in any way on the financial planning side, on the accounting side, our contact information for myself, reach out to my assistant and she'll set up an appointment, assistant@latitude-west.ca. And like I said, all of our first meetings are completely complimentary. I just, want to see if there's a good fit and if there's any way that I could help. If you want to reach out to Nathan, it's at nmorrison@provisiongroup.ca. For those of you in a dental school or dental residency, a quick reminder is that Provisions is able to provide complimentary tax filing if you are in your dental residency. So feel free to connect, and we'd be more than happy to help you. So Nathan, thank you very much, my friend.
Thank you, Christian.
Until next time, thank you for your wisdom, and I hope that everybody is listening has got some great piece of value for it. If you're listening to the recorded link right now, by all means, be a friend. Pass this on, forward it on to someone who you think might be able to get information from it. All right, but having said that, I will sign us off, and we will talk at the next webinar.